What if I told you there's a way to get paid to wait for your favorite stocks to go on sale, and then get paid again when they recover? Most investors are sitting on cash, watching the market, waiting for the perfect entry. They never pull the trigger. Meanwhile, the market moves, opportunities disappear, and they're still waiting. Here's what they're missing. There's a strategy that lets you collect real cash income every single month, whether the stock moves up, sideways, or even slightly down. And if you do end up owning the shares, you wanted them anyway. I've been trading this exact approach for years. It's not a secret, it's not magic, but most people either don't know about it or they think it's too complicated. Today I'm going to show you it's neither. Before we get into it, quick favor. If you want consistent research-backed market content every week, hit that subscribe button right now. It costs you nothing and it makes a real difference. Here's what we're covering today. 1. The philosophy behind this strategy and why it works. 2. The exact 6-step process I use, step by step, no fluff. 3. How I find the right stocks to run this on. And 4. Real trade examples so you can see exactly how this plays out in practice. Let's go. Before any tactics, you need to understand the mindset, because this strategy only works if you approach it the right way. Here's the core idea. I only want to own great companies, but I don't want to pay full price for them. And while I'm waiting to buy them at a discount, I want to get paid. That's it. That's the whole philosophy. I call it going for base hits. Not home runs, not lottery tickets. Consistent, repeatable base hits, month after month. Over time, base hits add up to something real. There are a few rules I never break. No penny stocks, no unprofitable startups burning cash, no names I wouldn't want to hold for years if things went sideways. Every stock I trade this strategy on is a company I'd be genuinely happy to own long term. Why does that matter? Because this strategy involves the real possibility of getting assigned shares. If a stock drops far enough, you will own it. And if you picked a garbage company, that's a problem. If you picked a quality business you believed in from the start, it's actually an opportunity. That's the shift in mindset. Assignment isn't failure. For the right company, assignment is just the strategy working as designed. Here's the full process. 6 steps. I call it the wheel. Step 1. Build your watch list. Create a focus list of stocks and ETFs you genuinely like for the long term. High-quality businesses, not just good companies. Good companies trading at prices where the risk is actually worth taking. This list is your universe. Everything else you do flows from it. I use TradingView to manage mine. The tool doesn't matter. The quality of the names on it does. Step 2. Screen for opportunity. Every day, sort that watch list by performance. You're looking for stocks that are pulling back, going on sale, approaching levels that look attractive from both a price and a valuation standpoint. This daily scan takes 10 minutes. That's it. Step 3. Sell a cash-secured put. This is where the income comes from. Before I do this, I run 4 checks. Check 1. Is the stock approaching a strong technical level of support? Is the chart showing me a price range where buyers have historically stepped in? That matters. Check 2. Is the stock trading at an attractive valuation versus its own history? I compare current metrics like price to earnings, price to free cash flow, and forward PE against the stock's 3-year averages. If today's valuation is below average, that tells me the stock could be pricing in too much fear, which means potential upside is being underpriced. Check 3. Is implied volatility elevated? Higher volatility means fatter option premiums, more income for the same trade. And here's the counterintuitive part. High volatility tends to mean revert. By selling a put when volatility is spiked, I'm often collecting premium right before it contracts. That accelerates my profit. Check 4. Is the premium actually worth the risk? I want to see at least a 15% annualized return on the premium I collect. Below that, the reward doesn't justify locking up that capital. If all 4 boxes are checked, I sell the put. Specifically, I target the 20 to 30 delta range, meaning roughly a 70 to 80% probability the option expires worthless. And I go 30 to 50 days out to expiration, which is the sweet spot for time decay accelerating without the risk profile going haywire. Step 4. Manage the trade. 2 scenarios. If the stock recovers and I've captured 50 to 75% of my maximum profit before expiration, I close early. Why sit around waiting 28 more days to squeeze out the last 25%? Take the win, free up the capital, move on to the next setup. Around the 21-day mark, I also evaluate whether to roll, meaning close the current position and open a new one further out in time. This lets me continue collecting income while adjusting my position if needed. Step 5. Sell covered calls if assigned. If the stock falls through my strike price and I get assigned 100 shares, the wheel shifts. Now I own the stock, which, remember, I wanted to own anyway at this price. And I start selling covered calls above the current price at a level I'd be happy to exit the position. Every week or month those calls expire worthless as another premium check deposited into my account. And if the stock rallies past my call strike and I get called away, I sell the shares for a profit and collect the call premium on top. Step 6. Repeat. Every time a put expires worthless, every time I get called away from a position, I go back to step 1. That's the wheel. It keeps spinning as long as you have quality companies on your watch list and the patience to keep running the process. Quick pause here. Drop a comment below. Tell me which part of this strategy you've tried before, or which part has been tripping you up. I read every single comment. It helps me know what to cover next. And if you're finding this useful, a like takes 2 seconds and genuinely helps this channel grow. I appreciate every single one. This is where most people get it wrong. They learn the mechanics of the wheel, they start selling puts on whatever stock their friend mentioned, and then they wonder why it blows up on them. The strategy is only as good as the companies you run it on. Period. Here's my process for stock selection. I want to see rising revenue, I want to see expanding or stable profit margins, strong or growing free cash flow, a balance sheet that isn't a disaster, and a valuation that looks reasonable relative to where the stock has historically traded. I actually built a screener, called the Stock Box, that automates a lot of this analysis. It evaluates things like PE ratio, forward PE, price to sales, price to free cash flow, revenue growth, earnings growth, return on equity, debt to equity, and more. It then spits out a read on whether a stock looks undervalued or overextended relative to its own history and its peers. I'm not going to spend this video selling you on software. The point is this: do the work. Use whatever tools you have access to. The goal is to find quality businesses trading below their historical averages on key valuation metrics. That's where the edge lives. Let me give you a real example. I recently ran this on Intuitive Surgical, ticker ISRG. They build surgical robots, long-term secular tailwinds, aging population, increased surgical demand, hospital automation. The kind of business that I think still looks compelling a decade from now. When I looked at it, the forward PE was sitting below its 3-year average. That's the signal. Not that the stock was cheap in absolute terms. Surgical robot companies don't trade at bargain bin multiples. But relative to its own history, it was pricing in more fear than the underlying business warranted. I sold one cash-secured put at the 425 strike, collected $10.30 in premium. That's $130 total for one contract. That put my effective purchase price at $414.70 if assigned, a price I was genuinely comfortable owning the stock at. Capital requirement, $42,500 set aside in my account. Annualized return on that premium, well above my 15% minimum threshold. All 4 checks cleared, trade executed. That's the process in action. Let me walk you through a complete example of the wheel working start to finish. Amazon. Yes, that Amazon. I started selling cash-secured puts on Amazon and eventually got assigned at a cost basis of 201 by 111 per share. The stock had pulled back. My puts went in the money. I took assignment. Most people would have panicked. I didn't, because I'd done the work. Amazon was a company I'd run through all my checks. Quality business, strong free cash flow, reasonable valuation for where it was trading. I was happy to own it at $201. Then the stock started to move. As it climbed toward levels that I considered fairly valued or slightly stretched, I sold a covered call at $245. I collected premium for being willing to sell my shares at a level I thought was reasonable. Now the stock has pushed past $245. That means my calls are working against me in the short term. The position has a ceiling. But here's the thing. I bought at $201. I collected put premium on the way in. I'm collecting call premium while I hold. And when the stock gets called away at $245, I lock in a meaningful gain on top of all of that. That's the wheel spinning cleanly. Entry, assignment, income generation, profitable exit. Not every trade goes this smoothly. Some stocks keep dropping after assignment. Some take months to recover. That's why stock selection matters so much. You need to be able to hold, mentally and financially, through volatility if it happens. Let's be real for a second. This strategy isn't bulletproof. Nothing in markets is. There are 2 main ways this trade can get difficult. The first is assignment on a stock that keeps dropping. You own it at $50, it goes to $35, and there's not enough premium in selling calls to make the situation feel manageable. In this scenario, you have options. You can lower your call strike, accept a lower exit price to collect more premium now. You can average down if you have conviction in the capital, or you can just hold. If the company is genuinely good, patient ownership has historically been rewarded. The second difficulty is getting called away too early on a big winner. You sell a covered call at $245, stock goes to $290, and you've left $45 per share on the table. That stings. But remember, you collected put premium on the way in, call premium while holding, and you captured the move from $201 to $245. That's still a win. You didn't get everything. You got a consistent, repeatable return. That's the trade-off. This strategy caps your upside. In exchange, it gives you income, a lower cost basis, and a high probability edge over time. If you're chasing 10 baggers, this isn't the right approach. If you want consistent returns from quality businesses, this is a strategy worth understanding deeply. Let me bring this all together. The wheel strategy, at its core, is about three things: owning quality businesses, getting paid to wait for good entry points, and generating income while you hold. If I had to distill the whole thing into one rule, only run this strategy on companies you'd be proud to own without any options around them. The options just make the entry and holding period more efficient. The underlying investment thesis still has to be sound. Here's how I'd prioritize if you're just getting started. Don't go looking for the highest premium you can find. That's a trap. High premium usually means high risk. Start with companies you already understand and believe in. Run them through your fundamental checklist. Find a technical level that looks attractive. Check the volatility. Sell puts at a strike you're genuinely comfortable getting assigned at. One contract at a time. Learn the mechanics. Build the habit. The compounding happens over months and years, not on a single trade. And if $425 worth of capital per share feels like too much, look into bull put spreads. Same concept, smaller capital requirement, cap downside. It's a slightly different structure, but the core logic is identical. Quick recap before you go. Build a watch list of quality companies you'd hold long term. Scan daily for oversold setups. Sell puts at the 20 to 30 delta, 30 to 50 days out, with at least a 15% annualized return. Close early at 50 to 75% of max profit. Take assignment gladly when it happens. Sell covered calls on the way back up. Repeat. That's the wheel. It's not complicated, but it requires patience, discipline, and the right stock selection to work consistently over time. Three things before you go. If this video gave you something useful, hit that like button. It genuinely helps the channel reach more people. Subscribe if you aren't already. I break down real trades, real analysis, and real strategy every week. No noise, no hype. And share this with one person you know who's interested in markets but hasn't found a strategy they're confident in yet. This might be exactly what they need to hear. I'll see you in the next one.